One thing that happens in the UK is the entrepreneurs tend to look at the tax breaks that are available, and there is an arbitrary £150,000 tax break that's been set by the government, and the entrepreneur seems to think that £150,000 then is what will be attractive to the investors. And from the investor's perspective, if you're asking for £150,000, I've almost switched off immediately. If you're at the very early concept stage, you need to kind of double or triple the amount of money that you need. Once you've got product and you've got some revenues and you've identified how to secure customers and what those customers are going to cost you to actually get on board, then the amount of buffer that you need reduces significantly, and you're probably looking at 25% then when you've got revenue and you know what your routes to market actually are on it. But it is very common that they just don't ask for enough money and they run out of cash. If they haven't got the contingency, dealing with an experienced investor like myself, I will suggest that if you're looking for £200,000 and it feels like £400,000 is the right answer, I would suggest that actually we should adjust it and go and raise a larger amount of money. If people aren't really open to that sort of concept, it makes it difficult to invest. From the investor perspective, when we typically will put a syndicate of angel investors together to do a deal, we're going to end up between us probably 25 to 35% in terms of that investment round. For the entrepreneur, it's really a case of getting as much cash as you possibly can for that investment round. We also have to factor in that the entrepreneur has to be incentivized to actually carry on and drive and run this business to the point of exit. So we need to also ensure that with this investment round and any future investment rounds, that the entrepreneur will still have enough to keep them incentivized.